Okay, in a little over an hour, the Bank of Canada will announce whether we get a rate cut or not. Let's preview today's decision with Merril Mascarenhas, a managing partner at Arcus Consulting Group. And Merril, thank you very much for joining us.
My pleasure. Thank you for having me.
The first question, are we going to see a rate cut?
There's an 80% chance we will see a quarter-point rate cut. That is our expectation. But the big question is whether we will see more rate cuts by December or not.
And what's your feeling on that?
It depends on how the Bank of Canada plays this out. If its position is that the economy has slowed down, inflation can be tamed over the next 3 to 6 months, chances are we may not see a rate cut. However, I think the devil's in the details here. The Bank of Canada needs to maintain its credibility and ensure that business confidence isn't eroded by the perception that inflation is under control, and then we see inflation continue to be sticky.
So, Merril, many expect the U.S. to start being very aggressive on interest rate cuts. We'll see a new Fed chair in the U.S. How does Bank of Canada react to that, and will it follow suit with cutting interest rates, even if it doesn't want to?
I think there's a larger issue here, which is the elephant in the room, which is USMCA and the impending renegotiation next year. So I think our economies are on different tracks. The Trump administration's intent is to negotiate separately with Canada and the US in 2026, because Canada over the past 10, 20 years has become more of a resource-driven economy. We've exported our heavy industries, whereas Mexico has gone the other way, has increased its manufacturing capacity, especially in automotive and in computers. So I think we have more downside over the next 6 months to 12 months, and the U.S. has more upside. And I think that is the challenge here. It may impact the Canadian dollar if we don't lower rates and we see rates drop in the U.S. So I think it is a challenging environment moving forward with another U.S. rate cut.
What will you be looking for in the report today from the bank?
I think there are 3 things we will be looking for. How far they push down their 2026 growth forecast, and that's an important consideration which may impact whether we have a second rate cut in December or towards the end of the year. But the second would be, do they maintain the neutral stance of about 2 to 3%? And the third would be how they frame global risks. And that's the big one that is on the table here as negotiations continue with the U.S. and China, and we're seeing new developments almost every week. So that's the unpredictable one. Our sense is the Bank of Canada is going to be cautious. It's going to talk about the challenges that exist in the global trade space. And if they take a cautious view and with some level of expectation around or containing inflation, which has been quite sticky at about 3%. So that is our view with regard to the 3 considerations that I think are on the table for the Bank of Canada.
We've seen in the U.S. a number of large companies announce layoffs. The expectation, of course, over the next 12 to 24 months is as we integrate more AI. We've seen videos yesterday of robots. Canada, as you mentioned, resource nation, Mexico manufacturing. Is there a potential for the labor market to be really under stress over the next year or so? And how does the Bank of Canada respond, even if it doesn't have that dual mandate?
That's a good question you raised, because one of the challenges with trade negotiations has been local content. And Canada, over the past 10, 20 years, has essentially outsourced a lot of its heavy industries, or the dirty industries, which relate to coal mining and steel and so on. So, for example, at this time, Canada imports about $16 billion of steel, forged steel and rolled steel, half of it from the US and about 10% from China. So that's not local content when it comes to manufactured products. So we see a lot of headwinds moving forward with negotiations. We've become more of an assembling country versus a manufacturing country. And for better or worse, the focus on clean energy and increasing our focus on the service sectors, which is slowing down right now, may have a significant impact on how much leverage we have moving forward. We are still very resource driven. 80 to 83% of our crude oil is refined in the U.S. at this time. So we don't have the refining capacity to even scale that up. So we're seeing some headwinds moving forward. But I think the challenge, I think, is more of stagflation, and the Bank of Canada should stay focused on that.
And what makes you worry about stagflation?
So the challenge with our environment, economic environment right now is growth has slowed down, business confidence is down, retail spending is down, investment planning is down, and inflation is sticky at about 3%. So if we see another drop in December or a bias towards lower rates, the question that the Bank of Canada may need to weigh carefully is, will we see a sustained environment of stagflation? And I think one of the pathways out of this is to ensure that business confidence is built without over-promising. So a quarter-point rate cut shouldn't indicate that inflation is under control. So I think the message is one of caution. There are so many unknowns, and it's likely that the global economic environment is going to be a significant focus in the Bank of Canada's statement, but we'll know soon.
Okay. Merril, thank you very much for joining us today.
My pleasure. Thank you for having me.
Merril Mascarenhas is managing partner at Arcus Consulting Group.